Let's turn now to the arc of countries between Korea through Southeast Asia all the way to India, which for the most part I'm going to treat as a group rather than go through each one seriatim. Otherwise, you might be sitting there for a couple of hours. Most Asian economies experienced negative growth or significantly slower growth in the first quarter of the year. And those that have reported second quarter data so far are consistent with a pattern we've already discussed for most other advanced economies in being much worse than they were in Q1. In Korea, for example, GDP contracted by 3.3%, nowhere near as much as it did in the United States or probably in Europe, but nonetheless, the largest decline Korea had experienced since the Asian crisis of 1998, and they're now experiencing negative growth year on year. In Singapore, real GDP contracted by 13%, according to preliminary estimates that were released last week. And that's Singapore's biggest contraction since the Asian financial crisis of 20 years ago as well. Hong Kong reported its second quarter figures on Wednesday night. They actually showed a slight increase quarter on quarter in Q2, but because Hong Kong's economy has been contracting for much longer under the influence of the internal unrest that's been in evidence there for the last year or so, its economy is also significantly smaller than it was in the second quarter of last year. Elsewhere in Asia, the Philippines had a very dramatic slowdown in the first quarter, much more so than Indonesia, Malaysia, or Thailand. But all the indications are that those economies will have slowed further, if not gone into negative territory in the second quarter of the year. And that applies for Australia and New Zealand too. Vietnam will probably be the only economy that clearly escapes negative year-on-year growth, although India may do too. If you look closely at the chart in the top right-hand corner, you can see that India's economy has actually been slowing for quite a number of years, and astute observers of the Indian economy have been becoming increasingly sceptical of earlier hopes that the government of Narendra Modi could repeat for India as a whole what he was able to do during his earlier period as the Premier of Gujarat on India's west coast, where he was very successful in growing that state's economy, albeit at the cost of tolerating, if not provoking, greater unrest between India's two major religious groups, something which also seems to be happening on a broader scale under his administration. Most Asian economies also publish purchasing managers' indices, analogous to those that I discussed in the context of the major advanced economies a few moments ago. And like the major advanced economies, they all show significant declines, albeit to varying degrees, during March and April. And some of those economies have bounced back strongly in May and June. It's only India and Australia and New Zealand who publish services sector purchasing managers indices. And in fact, the services sector PMI for India in March of just 5 was the lowest reading that any country has ever had for a purchasing managers index. And although that's rebounded in May and June, it's still well below where it had been before the pandemic broke. Most other Asian economies' manufacturing sectors have gone a fair way back to where they were pre-pandemic. In the case of Vietnam and Malaysia, they've got back to that point. But in several others, including Singapore and Taiwan and Korea, there's still some recovery yet to go. Just for the sake of mentioning it, probably the economy that's experiencing the worst recession in the world is tiny Macau, where GDP fell by 50% almost in the first quarter of this year. And then, as we learned this week, fell by another 2.2% in the second quarter. Of course, that result is an inherent result in the very narrow base of the Macanese economy. It's almost entirely dependent on tourism and gambling, and both of those activities have fallen by more than 95% since the start of the year, largely as a result of restrictions on travelling to Macau or anyone else imposed by the Chinese government that was a major source of tourists and gamblers to Macau. The fact that, as I mentioned earlier, most Asian economies have been fairly successful at confronting the coronavirus doesn't guarantee that they will have a fast economic recovery. Most Asian economies are very exposed to the global economy. For many countries, that means exposure to China, which is particularly true for Hong Kong, of course, but they're also significantly dependent on exports to Japan, to the United States, and to the European Union. And for countries for whom exports are a very large proportion of GDP, which is Hong Kong and Singapore spectacularly so, but most of the others, except for Indonesia and the Philippines as well, the potential drag from exports is something that could well weigh on, detract from what might otherwise be a more rapid recovery in domestic economic activity. And we can see by looking at the monthly merchandise export data that Asian countries put out, that several of them have experienced ongoing deterioration in their export performance. For some, like Korea, that's been as bad as it was during the financial crisis of 12 years ago, and that's also true of the Philippines. For others, not quite as bad yet, but say for Thailand, which is the motor vehicle manufacturing sector of Southeast Asia, any weakness in global demand for motor vehicles would be something that would hit its exports relatively hard. Again, you can also see how significant the deterioration in India's exports has been. Exports aren't particularly important for the Indian economy, but nonetheless, that's something that's going to weigh on their economic performance as well. In addition to being exposed to exports of goods, many Asian economies are also very vulnerable to a prolonged downturn in tourism. We've seen that happen in Hong Kong, of course, over the last year, with many tourists shying away from the territory because of their concern about being caught up in all the political mayhem there. Tourism has also been an important factor in Japan's economy in recent years, and all of those have experienced some significant declines, and of course they will get worse as the year moves on. The chart on the right shows just how exposed different economies are to tourism. In this case, Asian economies I've coloured in blue rather than pink as I did in earlier, and you can see that among the economies we're talking about here today, the Philippines and Thailand, Hong Kong, Malaysia, even China itself, as well as Singapore and Vietnam, all have significant and measurable exposures to tourism, and tourism will be one of the last areas of economic activity to be freed from the restrictions that it's currently subject to. Indeed, I suspect that it will be a long, long time before long-distance tourism in particular get back to pre-pandemic levels, if indeed it ever does at all. Most economies, as I've mentioned, are very open to trade, but there are some, most obviously India, which remain staunchly protectionist. India, you'll recall, couldn't even bring itself to sign up to the China-sponsored Regional Economic Comprehensive Partnership that was China's alternative to the American-sponsored TPP, or TTP, Trans-Pacific Partnership, that the United States in the end also dropped out of. And RCEP, the Chinese-sponsored agreement, wasn't all that demanding in terms of the liberalisation it anticipated from its would-be members, but even India couldn't even agree to sign up to that. India's also been the most prolific user of anti-dumping actions of any country, although Australia doesn't cover itself with glory when it comes to that. India, and perhaps surprisingly to some, Korea, apply much higher tariffs to imports than other countries, and it would be nice to think that at least within the ASEAN bloc itself, the recessions that are now being experienced wouldn't represent an insuperable barrier to continuing with the gradual liberalisation of intra-ASEAN trade that the bloc has been trying to achieve over the last 10 or 15 years. Certainly, further progress in that direction would be helpful in promoting a sustainable economic recovery from the present downturn. In most of the more advanced Asian economies, inflation has been very low, and in many cases lower than central banks are officially targeting. In some, in particular Singapore and Taiwan, inflation has actually turned negative, and Korea has flirted with that towards the end of last year and the first half of this year. In the less advanced Asian economies, inflation, though low by historical standards, hasn't fallen by as much as it has in most of the more advanced Asian economies. Although in Malaysia, where, for example, the relatively new government's first action was to abolish the GST that the Najib government had introduced, that's reflected in the movement into negative headline inflation that you can see in the bottom middle chart in there. When we look at currencies, there are four that stand out for having been relatively stable through all of this turmoil. The new Taiwan dollar, the Hong Kong dollar, of course, because it's a currency board arrangement that's tightly fixed to the US dollar. To the surprise of many, the Philippine peso had appreciated gradually rather than falling, as most other currencies in the region did during February and March. That wasn't because the Philippine Central Bank was actively intervening to support the peso. It was rather a reflection of more favourable assessments of the Philippines' position by some of the leading rating agencies that came out during that period. And of course, the Vietnamese dong, which is fairly tightly managed by the State Bank of Vietnam, has been pretty steady as well. And the decline in Vietnam's trade deficit has certainly made that task easier for the Vietnamese authorities. However, some other currencies, particularly the Singapore dollar, the Indonesian rupiah, the Thai baht, and the Malaysian ringgit, fell very steeply against the US dollar during that period of heightened market uncertainty that I referred to earlier. But since then, they've recouped most of their gains up to early June. The rupiah and the baht have reversed some of those. The Indonesian rupiah hasn't Indian rupee, I should say, though it stopped falling at the end of March, hasn't really recovered much of its losses, unlike most other Asian currencies. And of course, the Australian and New Zealand dollars that also got caught up in that turmoil in February and March are now back to higher levels than they were at any time really since the first half of 2019, largely on the back of a weaker US dollar, although the resilience of the iron ore price has also been very helpful to keeping the Australian dollar up. Just as I looked at the policy responses of governments and central banks in the big economies, I want to briefly have a look at what's been happening in the other Asian economies. Most of them, with the exception of Japan and Hong Kong, have responded to a lesser degree on the fiscal policy side than the big economies have. And of course, that's the reverse pattern of what has occurred by comparison with the global financial crisis. Most of Hong Kong's fiscal response has been by way of liquidity support for banks and the short-term money market. If you took that out, then there wouldn't be much difference between Hong Kong and other Asian economies. Japan, of course, has been provided a great deal of income support to its businesses and households, and as a rich economy, it can obviously afford to do that. Most Asian countries have felt, to at least some extent, constrained by the fiscal rules that they've imposed on themselves, or by doubts as to whether they'd be able to finance a big increase in their budget deficits as readily as the major advanced economies have done. In a minute, we'll come to look at a couple of the ways that some Asian countries have been seeking to get around some of those constraints. But let's just, before we get there, have a quick look at monetary policy. Most of the higher income economy central banks have cut their policy interest rates to record lows over the course of this year. Some, if they needed to, would have scope to cut more, such as the Taiwanese central bank. Singapore and Hong Kong don't administer monetary policy through interest rates. In fact, Hong Kong doesn't have an independent monetary policy. It has to follow what the Federal Reserve does as the inevitable result of having a currency board. Singapore administers monetary policy by moving its exchange rate rather than interest rates. But for what it's worth, short-term interest rates have also fallen to very low levels of their own accord by market movements in the course of this year. And the central banks of Australia and New Zealand have also cut their cash rate targets to record lows. Elsewhere in the region, most central banks have been a little bit more circumspect about cutting rates. In some cases, that's because inflation has been higher than it has been in other economies. In some cases, it's also out of concern about where their currencies might have been heading. But even so, by historical standards, in almost all of these economies, policy interest rates are also relatively low. As I mentioned, some Asian central banks have been experimenting with various forms of quantitative easing. In the case of Korea, for example, in addition to cutting their policy rate by a percentage point, as I mentioned, the governor in May of the Bank of Korea mentioned publicly that the BOK was considering using unconventional monetary policy tools to support economic growth. They've been supplying liquidity in unlimited amounts to financial institutions and accepting a wider range of collateral for repos than they would ordinarily do. This month, they lent 8 trillion won to an SPV, a special purpose vehicle that the Korea Development Bank established to buy corporate bonds and commercial paper. And like the central banks of advanced economies, they've been purchasing Korean treasury bonds in the secondary market, as well as lending directly to both the government and the private sector. And that's reflected in what you can see in the bottom left-hand corner as a very significant increase in the Bank of Korea's domestic assets scaled against Korea's GDP. Another government that's been going down this path is the Philippines, which expects its budget deficit to reach 8% of GDP and its public debt to rise to 50% of GDP. In March of this year, during all that market turmoil, the Banco Central Pilipinas, the central bank of the Philippines, bought $6 billion worth, 300 billion pesos of bonds directly from the Treasury Bureau under what was initially a 3-month repo arrangement that's since been rolled over for another 3 months. It's also indicated a willingness to purchase another 200 billion pesos of government bonds. So far, it hasn't done that. That comes pretty close to printing money in the popularly used sense of the term, buying bonds directly from the government rather than through the secondary market. That may be why the BSP has been fairly sparing in going down that path anymore. Perhaps the most interesting developments are in Indonesia, where Bank Indonesia has entered into a formal burden sharing agreement with the Indonesian government, under which it's undertaken to purchase 400 trillion rupiah of government bonds from the government. That's equivalent to about a quarter of this year's government financing task at its benchmark reverse repo rate, and it's going to return all the interest the government pays it back to the government. So far, it's purchased about 37 trillion rupiah of government bonds, directly from the government, that is, and prior to that, they also bought about 166 trillion rupiah of bonds in the secondary market. In addition, under this agreement with the government, they're going to subsidise the interest on another 177 trillion of rupiah bonds to fund lending to micro, small and medium-sized businesses. This is a program that hasn't started yet because the Indonesian government has had difficulty setting up the means by which they can identify eligible businesses and set them up so they can receive loans. But that's something else the BI has committed to. In April, Bank Indonesia cut banks' reserve requirements by 200 basis points, but couple that with a requirement that the banks use the funds that they therefore had access to purchase government bonds, which the banks have then done. Their holdings have increased by more than 200 trillion rupiahs since the end of the year. The BI has its own word for all of this. It doesn't call it quantitative easing, it calls it synergic monetary expansion, which it's doing in addition to more conventional monetary policy, which it still has some scope to do. The BI's current policy indicator rates, its reverse repo rate and its one-day deposit rate are now all at record lows. Finally, let me just look at some other medium-term risks for the Asian periphery. That is, I've already talked about risks to China, but what about other economies? Well, like every other country around the world, second waves of infections are something to worry about in the near term, particularly in countries that have eased restrictions without having previously flattened the curve, like Indonesia and India, but also, as we've seen in recent days, in countries which have previously thought they'd gotten on top of the virus, like Hong Kong, that have had to reimpose restrictions on the movement and gathering of people. Also, for countries that have kept severe restrictions for longer in place to contain the spread of the virus, the downside risks to the economy will obviously be greater, and the Philippines seems to be a standout in that category. Another risk for Asian economies is the possibility that the major advanced economies, out of a desire to gain what they think might be greater assurance over the supply chains for essential products, or for other, perhaps more baser protectionist motives, will seek to bring back manufacturing and other activities onshore rather than outsourcing them. That's obviously something that the Trump administration has been pursuing for some time. And if it goes further down that track and other countries decide to copy it, then economies like Taiwan, Thailand, Malaysia, Singapore, and Vietnam, who've been active participants in global value chains, which has in turn been an important driver of their economic growth, could be in for an unpleasant surprise. And that might partly offset the gains that countries like, in particular, Vietnam had been hoping to reap from the relocation of production out of China in order to circumvent US tariffs on imports from China, or as a byproduct of the fact that particularly the coastal regions of China aren't such cheap labour destinations as they used to be. I already mentioned in passing that another risk for Asian export dependent economies is prolonged downturns or very sluggish recoveries in major export markets. And while a lot of Asian economies have reoriented themselves towards China in recent years, when we look at Vietnam or the Philippines or at Taiwan and even India, a large proportion of their exports go to the developed world, to the US, Japan, or to the EU, rather than to China. And even for countries like Malaysia and Hong Kong, who are more directly exposed to China, a lot of what they export to China is in turn used in making China's exports to developed markets. So they may not be as protected from an extended downturn or very sluggish recoveries in the major advanced economies as the headline composition of their exports might suggest. Another potential risk is ongoing aversion on the part of investors to all emerging markets, whether it's justified or not. A particular concern here could be for those countries that have large current account deficits or large foreign currency denominated debts, which would be at risk if their currencies were to depreciate. In general, Asia is less exposed to that than other emerging market regions, in particular Latin America, and to some extent Eastern Europe are. But for other countries who've typically depended on issuing bonds in foreign currencies to finance part of their deficits, and Indonesia stands out as a particular concern on that front, then a disinclination on the part of investors in advanced economies to take on emerging market exposure could prove problematic. I mentioned before ongoing or rising disappointment with, or even exasperation with, India's failure to live up to the expectations that accompanied Narendra Modi's victory in elections there 2 elections ago could become more widespread and perhaps heightened by India's poor performance in dealing with the virus. And the last risk I want to mention here, not in any way really related to the coronavirus, but nonetheless something that is particularly an issue for South and Southeast Asia, is climate change. People have to some extent put that to one side as a result of the focus on the virus, but in the course of preparing for this talk and others, I came across some research by a German environmental NGO that suggested that of the 10 countries most affected by climate change over the past 20 years, 6 are in the group of countries we've been talking about today or very near to them. That's Myanmar, the Philippines, Vietnam, Bangladesh, Thailand, and Nepal. A large proportion of Asia's population lives in cities that are especially prone to rising sea levels. Think for a moment about Manila, Jakarta, which repeatedly has floods almost every year now, Bangkok, Ho Chi Minh City, Yangon, Kolkata, Dhaka, and even Singapore. Cities that are potentially at risk if sea levels rise as much as scientists tell us they will, if global temperatures end up being more than 1.5 degrees above pre-industrial levels. And this map brings out fairly starkly in the red and dark red colours where the countries in the world who are most at risk from climate change actually are. They're mostly in a range going from Pakistan through Southeast Asia to the Philippines, with the exception really only of Laos and Malaysia, where at least some of the populations live in more elevated regions. So don't forget about climate change as a potential risk. That brings me to the end of this presentation. If you'd like to see the slides again, or to look at Wednesday's presentation, which mainly focused on the Australian economy, you'll be able to find that on the website over the weekend. You can also see how to subscribe to a weekly update of these and other charts and gain access to other material and talks that will only be available very soon to subscribers. Thank you for being here this afternoon. I hope you found these slides useful in the decisions that you may have to make about your business or your investments, or maybe they've just brought you up to speed with an important region of the world economy, whether it's where you live or one in which you take an ongoing interest. If there are any questions, I'd be delighted to do my best to attempt to answer them. But otherwise, can I again thank you for being here and look forward to engaging with you once again. Thank you very much.